This conference will now be recorded.
Now I request CA Vikas Nikum sir to formally introduce today's speaker, CA Manoj Alimchandani sir. Vikas sir, over to you. Vikas sir, please introduce the speaker.
Okay, sorry. I missed the first.
So you're not audible. Vikas sir, you're not audible.
Yeah, can you hear me now?
Now you're audible. Now you're audible.
Okay, thank you. So it gives me great pleasure to introduce our first keynote address speaker, Mr. Manoj Alimchandani. CA Manoj Alimchandani is renowned in financial markets in the industry, institutional, corporates, professional areas for his deep knowledge and practical insights. Mr. Alimchandani qualified as a chartered accountant in the year 1984 with merit and has rich experience of over 30 years in investments, financial planning, tax planning, valuation, asset allocation, and wealth creation. CA Alimchandani has been panel speaker at various industry forums. Over the last 20 years, he has the benefit of interacting with managements of over 1,000 listed companies, and he was also public speaker at National Conference with ASSOCHAM on 11 July 2018 on capital and corporate bond markets. He has presented a paper on corporate governance at Institute of Company Secretary of India, that is ICAI. He has also been a regular panelist on financial statements, accounting standards, CARO, and financial reporting in the global and Indian context. CA Manoj Alimchandani has been a lead panel speaker at major initiatives including digital events for BCAs, that is Bombay Chartered Accountants Society, in the year 2020. Mr. Alimchandani has been nominated as a co-opted member of ICAI for Shield Panel for 2021-22 for Research Committee of ICAI. Earlier, Mr. C.A. Manoj Alimchandani has been co-opted on Economic Advisory, WTO and Commercial Laws Committee in the year 2018-19 and co-opted on Committee on Financial Markets and Investor Protection in the year 2015. He has also been actively contributing since many years in various committees in ICAI, WFC, CTC and various bodies. Mr. Alimchandani has also participated actively at Equal Streets, a citizens' global movement supported by police, BNC and media, that is Times of India, and reputed citizens and NGOs. He is also well-known yoga trainer, sharing practical issues on lifestyle and stress management and health concerns. So with this, I hand over the session to Mr. Manoj Alimchandani. Kindly welcome with a round of applause. Thank you.
Thank you, Vikas. That was a wonderful introduction. Now I request Manoj sir to start with the session. Manoj sir, over to you. Thanks is yours now.
Thank you very much. Namaste, everybody. It's indeed a pleasure, honor, and privilege for me to be invited by this august body and honorable conveners and a wonderful team at the program organizing unit of ICAI. Wonderful initiatives have been done by you from the knowledge I have got from the founding conveners and also the current convener. You people are doing really a wonderful job. Hats off to the team of the program organizing unit of ICAI. I am really delighted you have called it a digital capital market summit. As the Prime Minister says, and the global also heads of various countries says, it is a new world digital. Digital India has been the buzzword for quite a few years. In fact, I was a part of the Digital India, Startup India, Make in India Summit at the ICAI auditorium. We had a major conference with top company law officials, which I was chairing. And we had a thing where the Ministry of Company officials said, that a startup company can be formed within 24 hours, certificate of incorporation can be given. And who can do startup? It is a chartered accountant, right? They help in forming companies. Not only that, every chartered accountant itself is a potential to do a successful startup. Isn't it true? I am right, friends? I would like the session to be interactive, and I would like to connect the whole story of capital market latest developments with digital story and each and every member of this program organizing unit. You have mentioned the number of members to me. I don't know how many are participating, but I am sure the conveners and the team would reach out to millions of stakeholders globally with the good work you are doing. The digital platform gives a very good opportunity to each of you, the conveners and participants team, to reach out to global stakeholders, every investor, every professional. We are talking about multidisciplinary team, and every citizen who reads your reports. Lots of people, chartered accountants in this program organizing units prepare reports. They are used by the global stakeholders, if I'm right. So this program which is done today, if it reaches the dreams of the conveners and the participants to reach out to all the global citizens, it will be a wonderful initiative. So the key issues which come out from here is actually how do we interact and gain knowledge and do value addition to ourselves. We have seen when we qualify, lots of people have experience. I will just guess the participants of this prestigious program organizing unit. There are some who are seniors and experts. There are some youngsters also, and some would have passed the final CA exam, would have become new members. It was a pleasure and honor for me actually about 9 years ago when I was requested by the conveners team to present a red a band with a golden locket to over 100 CAs who had qualified. It was this very program organizing unit which had called me, and in fact I was delighted. About 10 or 15 participants, they called me on stage, and the youngsters who had qualified, they were honored by this same program organizing unit, and they with a red band and with a golden locket on the shoulder, on their necks. You know, it was a kind of a prestige, very good initiative by the same program organizing unit in the same location. So the whole idea is to gain value, and how do we do it? We interact with multidisciplinary teams, and multidisciplinary teams are a part of your colleagues. They are often in your family when you are doing work from home, or in your offices, whether they are chartered accountants or they are chartered accountants from other countries like England and Wales, or USA, CPA, or Australia, or Canada, or could be engineers, or they could be technocrats, or they could be other project consultants, advocates, litigation people. Ultimately, we need to interact with multidisciplinary teams and see value added to ourselves, our family, and our clients, and the stakeholders. Stakeholders mean actually every stakeholder. It could mean the user of the reports which each of you is preparing, whether it is valuation reports or whether it is reports to RBI or SEBI or to the client, whether it is audit report or tax audit report or a valuation report or certificates. Stakeholder includes the SEBI, it includes RBI, it includes your client, it includes the tax authorities, IT authorities, includes the GST authorities, it includes the appellate authorities who use the reports for making the judgments. It includes the IT professionals, you know, digital. So there is a lots of things. I believe I would like each of the participants in this digital global capital market summit to share their views and expectations, whether we can do in this program in the limited time we have, with gaining the deep knowledge of the presentations which are being done by the eminent speakers, and also beyond. Each and every participant needs to add value and to become really a globally successful chartered accountant, or some of you may like to call it globally successful startup entrepreneur. So ultimately, it is about the potential of every CA, particularly the members here, and also millions who will be watching it through digital initiatives, YouTube, Facebook, Instagram, or other digital media. Knowledge sharing is all about, sharing experiences so people can benefit. Knowledge shares is knowledge gained. This is what our chief convener of this program organizing unit mentioned to me. How do we add value? Whether we are in practice, whether we are in part-time practice, or industry members, or consultants, or mutual fund distributors, or PMS distributors, or registered investment advisors, or a registered research firm, a research house, or a research analyst. So you could all participate in the India growth story as a value-added professional, as a corporate entity, which many of you are experts in floating, or as individual capacity. Individual capacity is the most important capacity because we have been given constitutional liberties by the Constitution of India, right? Lots of liberties are there. So it is time to be a successful professional actually for each member of the CPE organizing unit, and develop how do we become successful? Develop deep domain expertise in most sectors, professional areas, financial services, accounting services, taxation, planning, litigation, manufacturing sectors. Most of you who have been alert have been seeing a lot of buzz on PLI scheme, right? Production Linked Incentive Scheme for the India growth story. Lots of companies like Apple, Foxconn, they have signed agreements, and they have done commitments also to manufacture in India, give a boost, and some special conditions were negotiated. But luckily our government went ahead, so see that India becomes the fastest growing economy, and not only that, we achieve our targets of that $5 trillion GDP ahead of time. And today we are counted, some say among the sixth largest economy, some say fifth, some say fourth in terms of purchasing poverty. But are we sixth, are we fourth, or are we fifth, or are we number one? It is my honest and humble belief we are ahead, and India has contributed to the cosmic universe, and all other countries have learned from it, whether you call it in earlier centuries or pre-independence era. So ultimately we are number one, and in terms of the global rankings, the way GDP is calculated, also a time will come we'll be number one, also recognized by everybody, and all the heads of countries, prime ministers would reach out and themselves want to come to India and bring investors and invest their own money also. This is the ultimate objective of how the India growth story has to work. Now, where some people say 2050 for India, number one in GDP, some people say 2040 or earlier, but $3 trillion US dollar economy target, which was earlier, has been shifted to 2026 because of this pandemic which has happened. Hopefully it will be much ahead of that time, and fiscal responsibility is also happening. And we have seen also Indian currency, which was becoming weaker year by year, for whatever reasons, I have started becoming stronger now. Year by year is yet to be seen, but month by month and day by day, at least Indian currency is becoming stronger. So there are lots of issues where each member of this POU, Program Organizing Unit, CP unit of the Institute of Chartered Economists of India, can really do. And startup is innovation. Like the convener team has been doing a lot of innovations, including today's program, Digital Capital Market Summit, is the biggest innovation by any POU, I believe, this year, or since last 10 years, if I remember correctly, right? I hope the convener team agrees with me. It is the biggest initiative you people have done digitally, and reaching out to everybody. Startups, there is some condition. If you go to the websites of startup policy, there is some condition of innovations which you have already initiated innovation and been successful, but you have to do within the framework of the innovation to see that you get the approvals of the startup government at a national level. The office is in Delhi, and also state units are there, Maharashtra unit. And that innovation, if you do, then there is a lot of tax benefits also. Most of you are aware, and that when you sell house, you used to get 54F for reinvestment in houses, right? And there are also some schemes for investing in startups subject to those conditions of innovation, which I'm sure I would suggest each of you to do the deep dive, which the think tank team has been doing deep dive since over a couple of decades. So do deep dive. Actually, think tank was the theme suggested and finalized by the convener team of this program using organizing unit. Every CA is a part of think tank. Otherwise, it was known to be some foreign think tank. You know, what is this foreign think tank? Somebody in USA or a World Bank and IMF, you know, sitting in ivory towers. No, every member of this program organizing unit, POU of ICAI, is a think tank participant. That is the crowning glory. Our chief convener and the whole convener team, past, present, future, has decided you're all participants of think tank. You have to think on your feet and be ready to respond to any family member, whether it is health issue, professional issue, or wealth creation issue, because they want you to create wealth and hopefully in the most ethical and integrated, with the highest level of integrity. Your clients has highest expectations from you. It should be done with ethics and integrity. And as a think tank participant, so you can think and really share your experience and latest developments with every client or every stakeholder. That is a clear theme of this digital capital markets summit, which I hope it is conveyed in a very, very clear way, without any doubt, without any apprehension, without comprehension, and it is very, very clear. You need to interact with all domain specialists globally. In fact, many CEOs of global companies are from India, but they are working for the Firangi companies. Why? Because they get high salaries. Not only salaries, salaries are fixed pay. Often the CEOs are fired because of 2-quarter results, or often on 1-quarter results, which results are often manipulated. And we all know that even the regulators, they wonder what is happening, and they take time to do deep dives. And auditors also, we know how the global auditors are working, what kind of limited access to real on-ground information they have, unless they do a deep dive and they themselves become participants of a think tank with their real-life experiences and behave with ethics and integrity. So this is very, very clear. Today they are earning incentives based on the profits of billions of dollars in a decade. Why not each of you, the member of this POU and participants, can't you earn those kind of numbers? It is possible. It is really possible if you add value and become a think tank participant. I'm sure you can do it. If anybody has doubts in the interactive session, raise your hand, show your video, and say why you cannot do it. I would like to ensure that success is there, whether in terms of contribution to regulations, whether in terms of contribution to governance, risk and compliance. Many of them are experts in governance, risk and compliance. Even filing a TDS return is a part of compliance, isn't it? Convener team and participants, you are experts and you are contributing to the fiscal revenue and balances, and to see we have a stronger currency and we have the fastest growing rate in the world. And of course, it has to be do with ethics. You should get your whole input credit with full entitlements and the lowest GDP or the lowest IT rates or GST rates by proper representation. In fact, the whole think tank is based on how you can contribute. There are 4 R's. One of the former chairmen of WRC of ICAI has given a very respected member, known to all of you, and who also became a Central Council member. What are the 4 R's? One is resources, develop resources. Each of you chartered accountants is a resource person and who can contribute to resources. What is next? Research. Do research, do deep dive, look at RHPs, look at the sections, look at the case laws. This is deep dive of research needs to be done, various sectors, understand the sectors, understand the business. When you understand the business, all clients will come to you on their own. You don't need to do canvassing or form the multiple forms just for empanelments and getting audits for whatever, 3,000, 5,000, 30,000, 40,000, 1 lakh rupees. when the global stakeholders are earning money in millions of dollars and hundreds of millions of dollars, and we know the top 10 richest people in the world who are there, how many Indians are there, and whether they are employees or whether they are startup entrepreneurs. So we are talking about other opportunities, multidisciplinary team, business models, valuations. Valuations, many are experts and they can become experts, but what is key to understanding is understanding business models. So our clients have businesses. If they don't have, you can coach them, mentor them to see how to do business in the most ethical and integrity very commitment, and also to develop proper models based on proper ROEs and ensuring excellent consumer experience, which is key. Each chartered accountant should give a very good consumer experience to everybody. In fact, every chartered accountant himself is a consumer. Every participant here is a consumer of the continuing professional education, that experiences and knowledges are shared. Talking about reporting, there are annual reports. There are millions of annual reports of global companies available on the internet. I don't want to use the name of a foreign search engine. Ideally, Indian search engines names will come in the future. But there are reports, FRRB, Financial Reporting Review Board. Today, they just review and come out with some 30, 40 reports. But ideally, scan should be made of all the millions of companies and see which are the reports, which are the good, which are the bad, which are ugly. And if that is done in times, scams won't be known post facto from media after the money is lost. We will be able to prevent scams, or at least mitigate and reduce them to a large extent. We know about annual reports. Look, and today integrated reporting has been done. Integrated reporting was optional earlier. It has become compulsory for some large companies. Look at the integrated report of Reliance Industries. Why I'm taking this name, it is among the largest market companies. Look at the integrated report of Tata Steel. Tata Steel got a report, international report for the good integrated reporting award by a global agency, and our Indian professional bodies did not give a report, best integrated report award to Tata Steel. They gave it to a company called Associate Company of Coffee Day. I believe, how many of you know Coffee Day? We know of coffee experiences, but we know Coffee Day was involved in a scam, right? Their shares were attached by the ITO authorities, apparently for valid reasons, because they had proper information and they attached the shares. And everybody knows about what the promoter did in Cafe Coffee Day, right? What is his fate? Is he alive, or is it, or what has happened to it? And he was also a kind of a big stakeholder, large stakeholder in Mindtree, and those shares were sold, and some prices in stock exchanges were done, and whether they are genuine market-driven prices or manipulated, you do deep dive and find out. And such companies are also, unfortunately or fortunately, they get awards. Ultimately, it is each chartered accountant who needs to understand the reports, integrated reporting. Integrated reporting includes ESG, that is environment, social governance. This is very important. This is stakeholders. Environment is very important to each member of this POU, as we need a healthy air, right? It is very important. We need good health. That comes from environment. Social. We are all social citizens. So social is that stakeholders has become a very good buzzword. Governance. So we are past masters in that. Everybody knows about governance, including the POU. We need to have the finest standards of governance, not only overall digital governance, corporate governance, independent directors, how the committees work and really contribute to India growth story. So these are actually, we always believe in latest developments and real life examples. So we have discussed about various sectors, technology sector, pharma sector. I believe I just saw some members who said they will do some presentation on pharmaceutical sector for this program organizing unit. I wonder if it has been done last year or is in pipeline. If you need any help, I am always available for you. Conveners have my connects and my contacts. So do a presentation on pharmaceutical healthcare sector. It is very, very vital. FMCG, ultimately what you eat, what you drink comes out from FMCG. Take a walk to a supermarket. you will find a lot of FMCGs. So look at that. How do we make money investing, right? One of the global financial wizards said that take a walk in a supermarket because supermarkets were in USA. Now they are coming even on the bazaar, even on the roadside. You see the brands available. Then you see their annual reports of those companies and whether they are integrated or not, and what type of disclosures, transparency, and ethics and integrity the management has. Quality is essential, but quality is very difficult to determine, isn't it? Quantities are there, numbers are there, numbers are often forged, numbers are often manipulated. This is which each member of the program organizing unit can do a deep dive and see where numbers are good. Real good wealth can be creating by way of investing for your own money. You can become your own wealth creator, your family's hard-earned money, or your savings, or your clients, or any stakeholders. We can serve the government bodies. Today, gentleman participant of the multidisciplinary team said Virar website is among the best in the world. He was comparing it to the among the best number one site of the world, because it's a foreign company. I'm not taking the name with clear objectives, but Virar site is really very good. Each of you can contribute in that Virar. There is huge potential. Every flat owner is looking at Virar from angle of and regulation from angle of a cooperative society or a condominium or the deputy registered office or appellate, and there are lots of manipulations, forgeries, and falsification of accounts of cooperative societies which are going on with the connivance of some elected committee members or even committee members. They claim to be elected and they are not elected. Even the committee meetings of the homes societies, their minutes are manipulated and forged, and auditors, whether they are members of professional bodies or not, they are not even having access to the correspondence of members, and they are signing reports. Whether disciplinary action is taken or not, everybody knows of the huge queue in disciplinary boards, whether of the bar council or of professional bodies. You are aware of the professional bodies names, in India. So there is a lot which can be done on opportunities to guide whether it is Virar or cooperative societies or clients or mutual fund advisors or as distributors. NFRA, lots of people can contribute. Look at the NFRA site. There are lots of orders on NFRA. Like on Virar, there are a lot of orders. I believe thousands of orders which have been passed are available on Virar site very clearly, including appellate. NFRA website is giving you lots of actual orders which will help us to improve the quality of work, quality of working papers. Look at that. Ultimately, it is ease of business. Whether we look at the capital market, regulations, union budget, investor charter, look at it. I believe it was announced by the finance minister, investor charter, and securities code is coming. Global exchanges, whether work will shift from Mauritius and New York or London or Singapore to India, GIFT City. I believe a lot of things are happening. Each chartered accountant can contribute to that. So very National Stock Exchange, MSCI, Metropolitan Stock Exchange of India. I believe they wanted to get the Bitcoins listed on MSCI. I believe some of the biggest operators and biggest banks have stakes in MSCI, right? In fact, a couple of well-known chartered accountants who claim to be billionaires, they have over 5% stake in it. NSE halt. India growth story is all about market cap and GDP, which is captured by NSE in a significant way. NSE halt happened just about a few weeks ago. What is the consequence of the halt? I believe some of the panel speakers may discuss. But incidentally, we started an exchange on the same day. It could have been delayed in the same night. Lots of margin trading issues were there. Lots of other, hyper trading sites are there, which are online sites, and by companies, Indian companies. They are doing really good work, but the regulations, maybe they will improvement. There are some regulations. Each transcript in November, there was a SEBI regulation which talks about transcript or communication with all investors should be shared on exchanges with everybody. I wonder how many of you have access to it. Lots of conversations are going on with global investors, allotting anchors. business model are shared with them, why don't you ask for it? Why don't you give access to it to become richer yourself and also contribute to richness of your clients and stakeholders? So asset classes, PMS, insurance, whether you can insurance a risk management tool or commissions are involved, whether to participate in insurance or to make a huge wealth by way of ethics and integrity and be a part of the wealth creation process. That is very important. Competitive advantage, you compete with CAs in pricing and in lowering your audit fees. Why don't you look at competitive advantage of nations and industries and companies? Look at the 5 forces of Porter. Look at it. It can be used for corporates. Look at Z score, bankruptcies, IBCs, Z scores. You can identify bankruptcies in advance. I used to do Z scores before I passed my CA in 1983, alternate formulas. Then other scores, M scores and because fuels, and there are many other things which came up. RBI, blockchain, Bitcoin, crypto. There's a lot ahead to discuss, and each of you is welcome. Let's have a participative section. Let's look at the presentations. I believe excellent presentations are lined up on sectoral analysis, company analysis, sharing experience of AGMs, and the VivekPatra, which includes a slide where every professional, every member of this, each of you can contribute a slide to VivekPatra think tank and see that you achieved your objectives not only physically but also digitally. So I hope I have done justice to the short time allotted. I was allotted, I think, 45 minutes, but I said I will devote more time to interaction and to see each of you gets connected very, very well. I hope all of you are connected and fully charged up to take up the session till the time you have. Feel free to, I am available even if you extend the session further. Each and every question will be answered by each of the panelists and every should be participate. And any question you have, it will be my pleasure, honor and delight to answer every issue in a most positive way without any negative comments or contribution on anybody, any person, any company. But keep in mind, good, bad and ugly, they need to be identified very clearly, and each member of the professional body can contribute to that so that we grow and your objectives of Digital Capital Market Summit are not only achieved and they are exceeded and convener team become outperformers. Thank you so much.
Thank you. Thank you, sir, for wonderful sharing of knowledge. I think, sir, next we have an Ramesh sir program, correct? After this?
We can do English, we can do Thora Hindi maybe also, or any other languages. It's a global reach out. Conveners are trying to do a lot.
Yeah.
So Manoj, after your speech, I actually wanted to speak something on. Actually, listening to you, I just got reminded of something. When I become a chartered accountant, there was one of my senior. He spoke to me about what I should do with my first salary, and I really thought as like he gave me a suggestion. You should in your lifetime save 20% of what you earn. Either you save, or saving is basically investment. And when he said 20%, then he added 10% of that should be going to the personal development of you. So like if you say that you start your salary with 20,000 rupees monthly that time, he was asking that you need to start spending on your personal development, which can be in the form of reading newspaper, doing some additional courses. As you grow more, being a chartered accountant, you should add more to your knowledge. So the more you add that investment, your 18% will go better. So if you don't do that, you lose something in your life. And we are just 3 lakhs out of the 140 billion people, 1.4 billion people what we have in India. So we are just 3 lakh, around 3 lakh chartered accountants. So we should take full advantage. We should respect ourselves, keep adding to our knowledge so that when we speak in front of people, we know what we are talking, and we are well aware about what is happening in the industry. Thanks.
Very good insights, Aditya. In fact, I'm encouraged to share, if I'm allowed the permission, can I speak 1 minute more before we have the presentation?
Yes, sir. Yes, sir.
Convenient.
Yes.
Yeah, this is the same thing. When I started my career, I became a chartered accountant before the age of 21. And this thing was there. We were supposed to get 60 rupees and we were getting some 200 rupees. And we had to pay the fees from our own account. And we talked about 20%. And today, at my age, somebody said we should give in time to CSR and activities and contributing to another. We should give some 10% of our money. Then somebody said, Manoj, including one of the past presidents, he said, instead of giving money, you give time, 10% at a time. So then I decided it did not happen that year, but after a few years it happened. And something happened this month, a few days ago, which the chief convener is aware of. There was a hit and run and I survived some accident. I don't know, fortunately, unfortunately. And I was on the road. I gave up. I surrendered. I could not move on the left, could not move on the right. I had the physical injuries, which I still have now. But then I decided to give more time on activities for professional development of others. And I don't know whether it will be more than 20%, but I'm willing to give 50% of my time. Feel free to connect, at least during pandemic, as long as life is short. But don't forget the story, India growth story. Simple. There is no compromise on that. And each stakeholder can do with ethics and integrity. There are no fuzzy ways or shortcuts. The best shortcuts is the way of ethics and integrity. I feel you can do it. Again and again, I say, if you can't do it, connect with me. The chief convener is aware. I believe there is a change in terms, which is very good. Others are taking, but the team is always welcome to meet up with me physically, even tomorrow. And I'm available to see that objective of this digital capital market summit is achieved. And now I would like to.
I can speak about your inspiration always. Like I have seen that how you push people to do certifications and all. Yeah, that's really appreciate.
Pull. It's a pull factor. That's what the chief convener team, if he had not followed up, it would not happen. He really convinced us to do it before 31st, right? It happened. It has happened. And the meeting is being recorded. I want everybody to participate. Even 10 seconds or 20 seconds, put your video on. That will be the success story. Of course, after listening to the presentations, make it as short as possible for maximum participation. And our team member, I believe everybody is aware. Everybody is available. Life is short. Take advantage of it. Go and get it. India growth story.
Okay, sir. Now we'll start with next session after this.
Hello.
Yes, sir.
Hello.
Yes, sir.
Yeah. Thank you, sir. As I know, capital market is very best if we have a knowledge and we can get a and we can create a wealth. It's a right. Now, Pradeep, please speak to speaker.
Next speaker. Okay, sir. I think we have next session of CAM Ramesh, sir. Hello.
Yeah. Yeah, you're audible. This is Ramesh here.
Okay.
Can you move to the PPT?
So you're not audible, Ramesh, sir. Yeah, you're not audible.
Am I not audible?
Yeah, now you're audible. So before you start, let me allow Vikas sir to introduce Ramesh sir.
Hello friends. Training is the passion for CA Ramesh. Having worked extensively in credit assessment and credit certificate with
Your voice
strong
is a bit not clear. Vikas, your voice is not clear. Can you come closer to mic?
Can you hear now? Hello.
Yeah, yeah. So now audible. Not again. Your voice has got disconnected. Yeah, Vikas, sir, you're not audible. Can you check your mic connection?
Yes, am I audible?
Yes, sir, now you're audible. Yeah. Please proceed ahead with introduction.
Yeah. Training is a passion for CA M. Ramesh. Having worked extensively in credit rating and credit rating space, his strong desire to share the knowledge gained with others, particularly with credit and risk practitioners. He has been a trader while working with CRISIL and now an independent trader with CRISIL. Presently, since May 2019, he is running a consulting and training firm by name FinSights Consultancy and Training. He provides consultancy services relating to credit rating, private credit assessment, and risk management. Credit rating is a niche and highly professional domain. Therefore, the expertise and professionalism that he brings to the table adds immense value to the clients in their relationship with credit rating agencies. He also undertakes due diligence exercise of an entity on behalf of a lender or debt or equity investor and share an independent credit perspective, a vital input for credit decision, lending or investing. CA Aim Ramesh has a post-qualification experience of about 18 years, including 12 years of experience in credit rating domain. Initially, he had the privilege of working with the premier development financial institution IDBI and later with CRISIL Limited. While working with IDBI from the year 2003 to 2008, he gained an experience in specialties in corporate lending, restructuring, and recovery of project loans before moving to risk management role. With CRISIL from the year 2008 to 2019, he had extensively worked in rating of financial services companies, including banks, NBFCs, HFCs, broking companies, small finance banks, insurance companies, and have particularly specialized in gold loan companies, mutual funds, retail assets, and NBFCs, and affordable housing finance companies. He has worked with clients across the rating spectrum from B category to AAA rated clients and across geographies. In addition, he was a rating committee member. The rating committee experience helped him specialize in bank loan space pertaining to small and mid-sized companies across the sectors. Sir, please, we will be benefited with your session. You are welcome.
Yeah, thank you very much, Vikas. A very good afternoon to all the participants. Thank you very much for the conveners for inviting me to this session. And thanks to Manoj who has organized, who has helped me throughout the past few years in kind of shaping my thoughts and helping me to participate in such programs. So thank you very much, sir, for that. Um, so so this presentation that I have structured is in two parts. We'll talk about the NBFCs in the first part and about the credit ratings in the second part. So as we all know, ever since the debacle of ILNFS in 2018 September, when the default actually happened, the entire NBFC segment has been going through very challenging times. Initially, it started with the kind of crisis of confidence, right? People simply, whoever was lending to NBFCs, whoever was dealing with NBFCs, kind of pulled back and said that there is something wrong with the model. So gradually they realized that there were certain companies which were actually going overboard, and therefore not all companies, we should not paint all companies with the same brush. So gradually, as people began to realize that there are certain companies which were having models which were not sustainable, models particularly on the funding side, raising short-term funds and lending on the long-term side. So the lenders, particularly the lenders to NBFCs, realized that and started kind of opening up towards other NBFCs. But what happened was the NBFC, even before this ILNFS debacle, was going through a very challenging period because of the slowdown in the economy, and that continued even after the ILNFS debacle, as we all know. And in the entire ILNFS happened in the financial year 2018-19, in September 18 to be specific, and we had this slowdown even before that. So 2018 was a very poor year for, I mean, a very challenging year. Poor is a very lenient term. I think very challenging year for the segment. In 2019-20, though, kind of the crisis of confidence kind of went away. People started gaining the confidence in the segment. But again, the economy was doing poorly. As we all know, GDP was sub 5% for the year, and therefore there were challenges. And the big blow came through the pandemic. That was in early 2020. So for the past almost, I would say, close to 36 months, the sector has been going through very challenging period. It was kind of slowly recovering, but kind of had to be the pandemic's impact further laid it low, and that's what is continuing even today. So two critical aspects which are key challenges for the segment. When we are speaking about NBFCs, it's both the non-banking financial companies as well as the housing finance companies. I mean, the business models are very much the same, right? Raising funds either on short term, either from directly from the market or through intermediaries like banks, and lending mostly on the retail side. I mean, if you look at the HFCs, the business model is quite the same. Yeah, HFCs and NBFCs do lend to wholesale finance, but that's only about 10% of the entire NBFC book, NBFC loan book. So mostly NBFC means retail. So between both, so I will use the word NBFCs, but we can understand that as NBFCs and HFCs together. Now that the regulator also, there is a convergence in the regulator, and the regulations are also converging. Even before, when the regulators were different, there were many regulations which were similar to both of them. Now, whatever was different also after the regulator being the RBI now, the regulatory and supervisory jurisdiction has moved from NHB to RBI over the last 2 years gradually, and the regulations are also converging. So when we are talking about NBFCs, we are talking about the entire non-banking sector. So with that clarification, as I said, double whammy is because of the funding challenge, which came about because of the ILNFS debacle, that lenders lost confidence in NBFCs, and that continued till the pandemic. And post the pandemic, anyway, funding is not a major issue because growth is not happening, so funding is not a major requirement or a major issue. But the asset quality, sorry, I just forgot to plug in my charger. Now I have plugged in. Okay. But the pandemic has given rise to a different set of challenge, which is on the asset quality, right? Though we have seen in the past few months, that is particularly after the moratorium was over, which was in August 2020, collections have picked up. But I would believe that it will take at least this quarter and next quarter to kind of come to a conclusion as to whether the asset quality challenge, because of the pandemic at least, is something which is over or not. Though the asset quality challenge seems to be much lower as compared to our expectation during the pandemic, during the peak of the pandemic and during the moratorium. But still, I think it's too early to kind of say that the segment has pulled itself out of the asset quality challenge. So key two challenges that we'll talk about today is the asset quality and the funding challenge. When we look at the growth of the segment, I think for the first time in many years, the segment is actually going to shrink. They've been growing at, I have a graph at least for the last 10-12 years, which will tell you how the segment has been having very phenomenal, very high level of growth. But this is the first year that we're going to see actually the sector shrinking. The sector is not just shrinking, but also it is kind of ceding ground to the banks. Banks as such are not real competitors for NBFCs because they operate in mostly in two different segment of borrowers. Overlap is not something which is very significant. But there are segments where there are significant overlap, particularly housing finance and to some extent vehicle finance as well. So in these segments, when the NBFCs and HFCs are not growing, when they are shrinking, and banks are growing aggressively, particularly in the current year, banks have grown, whatever the extent they have grown in last year as well, in financial year 20 as well. Banks grew in the retail segment better than the wholesale segment. So on the one hand, we have seen NBFC growth come down, and this year it's going to kind of shrink. The book size is going to shrink. On the other hand, banks are growing, at least in the retail segment. Therefore, in the segments in which the NBFC is operating, in those segments, they're going to lose market share. And again, this is something which is happening, I think, for the first time ever, that NBFCs are losing market share to banks. So while I spoke about the challenges that the segment has gone through and is going through, there are some positive aspects as well, which is what is on the capital side. While NBFCs are quite well capitalized, even I would say they are much better capitalized than banks, even some private sector banks. They are much well capitalized. But what they have done is to raise further capital during this pandemic. Many of the banks also did raise capital. They had tons and tons of capital, but you cannot predict what will happen, what will be the aftermath of the pandemic, and therefore they raised capital, and so did NBFCs. And this is what I'm calling it as confidence capital. They don't need capital to grow their business. Growth anyway is not going to happen, even if when growth starts in the next financial year, supposedly. They don't need so much of capital, but they raised capital to kind of ensure that the stakeholders had confidence in their business. As you all know, lending is a very confidence sensitive business. Someone perceives that the entity is in some sort of trouble. I think it's enough for you to for the company to go into a disaster mode. So it's not necessary that you are actually in trouble. If any external stakeholder perceives you to be in trouble, I think it's as good as having the trouble itself. So to avoid all that, banks, NBFCs, any lending entity will definitely have or should have adequate capital. And this is what these lending entities, NBFCs and banks have done by raising capital. So it's a very positive thing that despite being well capitalized, many of the NBFCs, bigger ones, have raised capital, and that has improved the sentiment about these companies in the market. So we'll talk about in terms of numbers of the capital raised on all that in the subsequent slides. I think it's needless to say, please stop me wherever you feel you have a doubt or you want to express your point. Need not necessary that you have to wait till the entire presentation is over. I think it's better we discuss different points of view or where clarification is required then and there. Just a couple of slides I have talking about the basics of the segment. I mean, the classification, which is liability-based classification. The number of NBFCs are actually in terms of deposit-taking NBFCs, which you see on the left-hand side. There are just about 58 NBFCs. RBI has stopped giving deposit-taking licenses, I think, for a good 2 decades, if I'm not wrong, for a very, very long period of time, because RBI is not comfortable. I mean, within the 4 walls of this room, so to say, RBI is absolutely not comfortable with NBFCs accepting public deposits. So they are pushing those companies which are having the deposit taking license but are not using it, or using it very minimally. So through their supervisory jurisdiction, they are doing it, and therefore you have just about 58 companies. I think a few years back, this, if I remember right, this number was close to 200 odd NBFCs, and that's coming down. While you see another important aspect here is the NBFCs which are non-deposit taking and non-systemically important. This is the right side box, 9,123 companies. So non-systemically important are those entities which are less than 500 crore of asset size. So there's thousands of entities which are either doing business in a very small geography, probably within a few districts, or even in a particular city or town and adjacent geographies, or they may be just investment companies as a part of a large group where there are no external dealings. Maybe it is not lending to any external. It's part of the internal group of a set of companies. It's part of the group of companies, and they hold it for some purpose. So that is a large that is large in terms of number, but in terms of the asset size, I mean, that's I don't have the number offhand, but that should not be a very large number. Probably less than 10% should be the asset side of this 9,000 odd companies. So if you want to really focus, there are 2 segments that we have to look at. One is this deposit taking segment, which is about 58 companies, and this 292 companies which are systemically important, those entities which are 500 crore and more of asset size, and which have active business, lending or any other business. On the liability side, we saw the classification, and this classification is on the asset side. So this classification is majorly there for regulatory purposes, because you cannot have one regulation. I mean, the kind of products which NBFCs are operating in are very wide and diverse, right? They do retail finance, they do housing finance, they do wholesale finance, MFI, gold loans, you name it, and there it is, right? So you cannot have a single regulation which will be applicable to all these classes of NBFCs. For example, infrastructure debt in NBFC. I mean, if for any other NBFC, the minimum capital required is just about 2 crore. Right now, there is a regulation. There is a proposed regulation which plans to increase it to 20 crores, but as of now it is about 2 crores. Now you cannot have an NBFC that is an infrastructure debt fund NBFC which is about 2 crore minimum capital. So minimum capital required for a infrastructure debt fund NBFC is 300 crores. Similarly, there are similarly for an MFI, you need to have a separate set of regulations in terms of who is the eligible borrower, what is the interest rate you can charge. That is something very critical, right? Interest rates in India have been deregulated for at least 3 decades now, right? But this is the only segment where RBI has put a cap on the interest rate that can be charged, because of the social requirement. The segment or the NBFCs are catering to a specific set of borrowers who are poor economic flexibility, and therefore some sort of production is required. So you have this regulation on interest rates, which is in the form of a cap on the interest rate that can be charged. So if I give similar such examples, you can find why you have different 7 or 8 different sort of classification, and each of these classification and regulations applicable for each of these classified NBFCs are little different. I mean, in the sense that, as I said, capital is different, capital requirement is different for one. For example, CIC, which is a core investment company. Typically, this is a company which is a holding company for a group. For example, if you take a Tata group in the financial sector, I'm talking about the financial sector group of Tatas, or say Aditya Birla or L&T, whichever group if you take, there is one company that will hold stake in all the financial sector companies, right? Tatas have presence in say NBFC, lending through NBFCs. They have presence in insurance. They have presence in mutual fund. They have presence in the whatever segment that is. So you have one company which is typically you will have one company, and Tatas do have one company which is a holding company for their investment in the financial sector. That holding company is an NBFC, and the regulations applicable, and that company doesn't lend. It does not do any business. Probably it may do some amount of business somewhere. Typically, it doesn't do any business. The only cash flow for that company will be the dividend flows from its subsidiaries or its constituents. So that company, you need to have a separate set of regulation, and that's why we have a separate category called CIC NDSI, non-deposit taking and systemically important. It typically will be systemically important because of the investments it will have will be more than 500 crores. But again, with all this, most of the NBFCs, if we looked at the numbers earlier, right, most of the NBFCs will fall under the first category, NBFC, investment and credit company. Most of the NBFCs, even if you take the 58 in terms of deposit taking, or the 292 in terms of non-deposit taking, but systemically important, most of them will fall under this category. So I thought I'll give a broad overview of the structure of NBFCs. Now let's move to the business. This is a chart which captures the performance, or I would say the journey of NBFCs in the past 10 or 12 years, or even 14 years, I should say, 13 or 14 years. The lighter orange line is the growth of the NBFCs, and the darker orange line is the GDP growth, just for comparison sake. But my focus here is to compare the growth of the NBFCs during certain periods, of what's happening during that period, what was the impact, and how did NBFCs perform during that period. So if you start with the global financial crisis, which happened in 2008-9, prior to that, it was a boom period. I think between 2004 to 2007-8, it was a boom period. Every sector in the economy was growing, not just in India, but globally. So NBFCs were not left behind. They grew at a very healthy rate of upwards of 25-30% during those years. And global financial crisis came, and then the growth fell as expected. During the next few years, there was this monetary and fiscal stimulus, which we are seeing these days as government and RBI are extending to tide over, to help the operating companies tide over the pandemic challenge. Similarly, then RBI and the government extended such monetary and fiscal stimulus. And there was this again easy money policy followed by most governments, and particularly the US government during that period after the global financial crisis. What we are seeing today was kind of same kind of situation was prevailing post 2009-10, post 2009 and post the GFC, and it continued for a couple of years, and therefore the NBFCs were growing at real healthy rates of 23% and upwards. That was the period. Then again, then came this taper tantrum when the US government started withdrawing the easy money policy. And in locally also, if you look at, that was a period where there was so much of strain in the economy. People were saying that the government's decision-making process had kind of stagnated, policy logjam and all that. So because of that, in 14-15, 13-14 and 14-15, growth of NBFCs came down, picked up a little bit the next year because of lower inflation and probably the feel-good factors like a new government and all that. But again, demonetization was a big blow. It kind of slowed down the growth of NBFCs. And again, they were trying to kind of come up, and came this ILNFS debacle, which was initially, as I said, crisis of confidence, liquidity issues because nobody was lending. See, in an NBFC, unless you keep on borrowing, money is the raw material, right? So unless the NBFC keeps on borrowing, it would not be able to repay the loans. In a manufacturing company, the repayment of a loan comes from the cash generated out of its operations. But for an NBFC, it has to either come from its own loans which are coming back, the loans that are getting repaid from the borrowers. Those loans will go to repay its NBFC's liabilities. Or if the incoming repayments are being used for further disbursement, loans have to be borrowed. The company has to borrow loans further to repay its existing liabilities. And during that period, post the ILNFS debacle, nobody was lending. No lender, be it a bank or be it a capital market institution like mutual fund or insurance treasuries or whoever, HNIs, whoever were lending or investing in the bonds and CPs of NBFCs, they stopped doing. And therefore, there was a big liquidity crisis that NBFCs were finding it difficult to even repay the loans. So growth slowed down. They used whatever monies that were coming out of collections for repayment of its liabilities. And therefore, there was this liquidity crisis and all this. And as I said, after that, the pandemic struck, and the growth continues. The growth continued to decline. And this year, we are expecting a reduction, a shrinkage in the loan book. So this is the story of for the past 10-12 years. I have another graph which compares NBFCs with private banks and public sector banks. It may not be really right to compare NBFCs with public sector banks. One reason we can compare them with private sector banks is that private sector banks are also actively lending in retail, and NBFCs are mostly retail, right? So it's a kind of a better comparison. Public sector banks are not as active. The share in the retail market is much lower as compared to private sector banks. Second, about the culture of lending or the business practices, whatever we can
Ramesh,
call.
sir,
Yeah.
sir, demonetization was right decision or it was failure? What's your view?
Okay. See, demonetization, I don't think it achieved its objective of even reducing the black money, right? And that was the original objective. But I can take some heart from it that it has pushed up, it has speeded up the digitization process. As pandemic has literally speeded up the digitization process. I'll also talk about this subsequently. But I think demonetization was the first push that kind of pushed companies into this digitization process. That is a small consolatory thing that we can take heart from. Otherwise, I think it was its original objective of trying to eradicate or reduce the black money. That was, I think, was not achieved, because the hardships that came out of it, both for individuals and the economy, are very, very disproportionate, extremely disproportionate to the benefits that has come. or that was expected to come.
Thank you, sir. Thank you.
Yeah. So this comparison, if you see here, the lighter orange line is about PSU Bank. The green line is the private bank, and the dark orange line is the NBFC. So there is some change in the color. I'm not consistent. Sorry for that. So if you look at this private sector banks and NBFCs, they're growing almost in tandem, right? No major. If there is an upturn, you see an upturn in both of these segments. If there is a downturn, there is a downturn in both of these segments. So NBFCs are pretty that way. They're very, very comparable with private sector banks in terms of growth. So the line is quite very well intertwined, between. In fact, in many cases, till up to 2018, NBFCs were actually much better than even private sector banks. But in 19 and 20, as I said, because of the crisis of confidence, liquidity, funding, all that, NBFCs had to kind of curtail the growth, and therefore we have seen the orange line, dot line, falling sharply, much sharper than that of the private sector banks. Again, I think I don't have the 21 number, but as I said, 21 there's going to be a NBFC's growth is going to shrink by 3-4%. Sorry, I don't have the 22 number put on the graph, but I think 22 will again be not a great year. I mean, we have not done the recent assessment of NBFC's growth after taking into account supposedly the second pandemic wave of COVID that is coming up. But assuming that the second wave of the COVID will not be as impactful on the economy because of the vaccine and whatever reasons, because of we know better than what we were last year about the pandemic, so we can handle this better. Is based on this assumption. Again, even assuming this, even so much of positive assumption as well as for the pandemic is concerned, I think the growth is not going to be great, because again, for the growth engines to kind of fire will take time, and therefore the estimates are in the range of 3 to 4% growth in the next year. But this factors in the bounce back that has happened in the recovery. Because if you look at, I mean, if you had asked me what would be the growth in 22, I mean, if you had asked me this question way back in October or September of last year, I would have been very, very skeptical because it was the peak of the pandemic. And the economic engines were actually not just starting to kind of come out. But now we know that economy has bounced back much better than what was expected, and therefore we are expecting growth in the range of 3 to 4% for the next financial year. So this is what I was talking about when I said that there's going to be a shrinkage of the NBFC's pie in the entire lending piece. And it's going to lose its market share. So just to take you through these numbers. So in 2008, if you see the leftmost circle, donut circle, the inner circle, if you see, when I combine the aggregate of lending of banks and NBFCs was just 30 crore. And NBFCs had 12% share in it, okay, out of this 30 crore. In 2020, the entire piece has grown to 136 lakh crore. Sorry, not 30 crore, 30 lakh crore. Okay. In 2020, this has gone to 136 lakh crore. So, or 136 trillion. 1 trillion is 1 lakh crore. So, banks are somewhere around 102, 103, 105 trillion or lakh crore, and NBFCs are around 30 or under 30 trillion as on 2020 March. You see the share has increased from 12% to 18%, which is a big jump in this 10-12 year period. Now, this is going to continue. I mean, even the banking segment is not going to grow significantly in 21, and so does the NBFC segment. That's anyway going to shrink. In 22, again, the banks will kind of bounce back faster. They will accelerate faster, I should say. Accelerate faster. Banks will accelerate faster, and NBFCs may take a little bit because of the funding challenges, and therefore this 18% share which they had in 20 and which are likely to have in 2021 March, that's likely to come down to 17% in March 2022. So this is what we are seeing. I mean, it's not a major 1% is not something which is major, but it's a kind of a reversal of what has been happening in the last 10-12 years. Even during the height of the GFC crisis, even during the height of the say the taper tantrum or whatever, NBFCs actually did not reduce the speed. As you saw in the earlier graph, they were never growing lower than that of banks. But now, in the last, because of the issues that started after the ILNFS debacle, we are seeing very challenging times in terms of fundraising, in terms of asset quality, and therefore NBFCs are slowing down. Just another slide to give a background while we are talking about the current developments in NBFC and while we are talking about the future. But before talking further, I thought I will just help some of us who may not be fully aware about this space to just get a little bit of a background. So if you look at the products that the NBFCs are operating in, these are the products starting from, say, housing finance, loan against property, auto finance, construction equipment finance, gold loans, very popular these days, wholesale finance, which comprises the typical corporate loans, which some of NBFCs do, like Aditya Birla Finance or L&T Finance, or some of them do this corporate lending, like term loans and all that. It also includes the developer finance, which both NBFCs and HFCs do. This developer finance is under a lot of stress. We'll talk about it subsequently. So this wholesale finance piece is what is something which was the thorn in the entire flesh of the NBFC. And then people identified that this is the culprit and not the other segments. And therefore, they started kind of reviving the interest. The lenders, particularly the mutual funds, started kind of reviving their interest in the retail segment. So they left alone the wholesale finance segments and have kind of regained some interest in the retail segment of NBFCs. So that is the wholesale finance, and you have SME finance. I mean, if you compare LAP and SME finance, there is a very thin line that differentiates between LAP and SME finance. SME finance, you can say any loan given to a company which has say turnover of up to say 20-25 crore. I mean, within the definition of SMEs, it can be even 250 crore turnover as per the SME definition. But within the SME segment, the large ones typically prefer a bank loan. Those which are in the lower rung go to NBFCs, because NBFCs the funds are costlier, interest rates are costlier, and therefore the better creditworthy firms within the SME segment go to banks for their loan requirements. Therefore, I'm just keeping it at 25 crore of turnover. So it can be any entity of that size and of up to that size. And if it is against a collateral, typically it will be against a collateral, because in that segment, because of the poor financial flexibility, banks actually don't lend without the security. Just give me a minute, I'll close the window because there is noise from outside. Yeah, sorry. So there is no major difference between LAP and SME and the way in which lenders also treat. So what I kind of try and explain is that if a loan is given, just having the collateral, the comfort of collateral. So you have a say collateral of residential property or a commercial property or whatever, industrial property or whatever property, land or whatever, and you are giving without assessing the cash flow ability of the enterprise, of the entity to repay your loan. You're just thinking that as a lender, you're thinking that, okay, I don't care about his business. If he doesn't pay, I will kind of encash my loan by selling the property. So there are a lot of companies doing this, or I mean, the degree varies. They don't spend as much time in evaluating the ability of the entities to repay the loan. Their reliance on the property is more. Then we can call it a LAP, loan against property. And if it's actually a proper working capital assessment that you have done or a term loan assessment you have done, and the property that you're taking is just a fallback, in those cases we can call it an SME loan. So in those cases we can typically find that the coverage of the loan, the value of the property will not entirely cover the loan. It could be 30% or 20% or 50%, not 60%, not more than that. The value of the property will be lower. Whereas if it's an SME, the LTV will be just be 30%. Loan to value will be 30%. Whereas in proper SME, the value of the property may not be more than 50-60%. That will give us a difference between LAP and SME. Otherwise, you have personal loans, consumer durables. In personal loans, you have both credit cards also coming into the segment, consumer durables and infrastructure finance that we have seen. Some of them we can look at it as we go along. So on the right side graph, right side of the slide, I've given a graph talking about the inherent risk in the product. Right, there is a inherent risk in the product itself, and then there are risks in the borrower segment that a lender operates. But here we are looking at the inherent risk in the product. So if you take a home loan, the lowest of the risk, that you move from left hand side to right hand side, the riskiness of the product increases. And that's the idea of this risk continuum. Home loans, gold loans are less risky. Car loans are new car loans particularly are slightly more riskier but safe asset class. Used car slightly lower because of the lower borrower profile. Probably someone who is earning about say 5 to 6 lakh, who is just graduating from a two-wheeler to a car, he will buy a used car. Whereas a new car guy will typically be a well-heeled guy, a guy with a very sufficient level of income. So therefore, the borrower profile differs, and therefore there is a distinction between new car and used car. Loan against property, loan against shares. Except, I mean, it's a very well developed product done by NBFC. So very few NBFCs have really lost money. If it is operationally, if it is done in a manner as it has to be done. Then there's very limited possibility of losses, credit losses coming into this product. So what I mean is that if a share is given as a collateral and you have the share value has fallen to a particular level where you have to sell the share, and you sell the share, you recover the money, right? But what happens is that because of the client relationship, the borrower does not sell the share even at an agreed level. They try to give them more rope to the borrower, and therefore sometimes they end up losing, and the share value falls drastically, and then it becomes difficult for recovery, and therefore lose money. But that is more an exception than a rule. So again, that's why it's a very safer product. Commercial vehicles, very established product. Commercial vehicles are NBFC in olden times, maybe in the late 80s and 90s, are all commercial vehicles only. NBFC is synonymous with commercial vehicles. So the segment is very well matured segment. Every risk is understood in that segment, and therefore relatively safer product. Then you have SMEs, then you have the LAP, as much as LAP is a segment where we have not seen the track record because the business, sorry, the balance transfers happening very frequently till about 2018, and therefore we have not seen a good amount of traction or good amount of vintage of this product. But it's a very secure product, and therefore it's less risky. And anything beyond that is I should say moderate risk LAP, and anything beyond that is all risky products.
Well,
Sorry.
Dinesh sir, your voice is not audible.
Yeah, 1 minute. Am I audible now?
Your voice is audible. I think Dinesh Kotecha sir wants to make some point, and his voice is not audible.
no, I don't want to make a point. Sorry.
Okay. So I will have I'll have to slightly hurry up. So so if you look at this segment, sorry, this slide, this is just a breakup of the slide that I had given earlier. So for 2021, as you said, there's going to be about 2 to 3% or 4% shrinkage in the overall NBFC piece. Now we have given this slide gives us a breakup of that. Across the segments, there's going to be very, very low levels of growth in 21. Sorry, just a minute. So this actually gives a breakup of the growth across segments. Only gold loan is expected to perform better. That is about 15% growth that is expected in 21, and 22 as well. It's going to continue to grow. Anyway, that has done well in the past year as well, in 2020 as well. Whereas most of the other segments in 21 are going to perform, going to have a very, very low level of growth. In terms of asset quality, there has been a lot of confusion in the market because first of all there was this restructuring, but of course RBI was very clear that whatever moratorium was given, it will not go into that period should be excluded from calculation of NPAs. And then the moratorium, after moratorium, restructuring was given, and before that the Supreme Court came and stated that NPA recognition, NPA classification norms, but anyway, that has been vacated since I think last 2-3 days back. So there is going to be, as I said, asset quality is going to be a very key challenge for the NBFCs because of the pandemic, because of the economic, poor economic activity, whatever we can call. Because of that, asset quality is definitely going to be a challenge in this financial year, that is on March 31, 2021, and the next year. But numbers will not be visible. The stress will not be visible. The stress will not be seen in the numbers in 2021 because of this restructuring, whatever restructuring that they have given, which is estimated at around 5-6%. For the entire NBFC segment, NBFC and housing finance segment. And secondly, because of the approach that the banks have taken, the lenders have taken in kind of accommodating the interests of the borrowers. So therefore, whatever loans, fresh loans were given for SME, there is this ECL government guarantee, emergency credit line which is guaranteed by the government. So there has been a good amount of support which has been given to the borrowers, and therefore the real stress will not be visible this year. If things don't improve in 2022 during next financial year, probably the stress will then be visible in terms of asset quality, in terms of NPAs in 2022 March. So most of the numbers where they were in 20 will continue to be in that same range in 21 because of the support, because of the classification, because of the restructuring and all that. But one segment, which is wholesale finance, which I talked about earlier, which has, see, wholesale finance, just to give you some numbers, we talked about that 136 lakh crore, right, of the entire banking and NBFC piece, out of which 30 lakh crore is the NBFC piece. Within this NBFC piece, you have these two large government NBFCs of Power Finance Corporation and Rural Electrification Corporation, which is close to about 7.5–8 lakh crore. They are NBFCs, but they are arms of government. They are not real commercial entities, right? They have been set up with a specific purpose of lending to a sector and all that. So analytically, if I bring that within this NBFC, then my results are quite skewed. Therefore, typically what we do is that for analytical purposes, we exclude this 7 lakh, 8 lakh crore and look at the real NBFCs, which are 23–24 lakh crore, right? So the size of the NBFCs, excluding this PFCREs, is about 23 lakh crore. And this wholesale finance is about 3.3 lakh crore, which is about 15%, a little less than 15% of the NBFC segment. Even within this wholesale finance, you have this developer finance, which is the bigger issue. The biggest issue is developer finance, where which is about 60%, which comes to around 1.8 to 2 trillion. This 1.8 to 2 lakh crore out of this 3.3 lakh crore of wholesale finance. So what is the problem here? The problem is that for the last probably 2–3 years or even more, the residential real estate has not been doing well. And borrowers have borrowed money from NBFCs at pretty high rates. So they are finding it difficult to repay because of the poor sales velocity of their flats or whatever, their products are not great. Now, again, if you look at the wholesale finances NPA levels, it was about just 4% in 20. In 19, it was just about 2%. It was not showing. Even in 21, probably it will show a little bit. It was not showing because most of the loans, or at least half of the loans, were under moratorium. The NBFCs give moratorium to the extent of 3 years, 2.5 years, even 4 years, because the construction period is so long, right? Which is fair enough. But during the moratorium period, either interest, in some of the loans, interest is paid, but in some of them, interest also is back-ended. That is, after the 3rd year, interest also gets repaid. So the real stress, which is a big stress, which is again not visible in these numbers, will be visible probably not probably, will definitely be visible in 22. You see, 15% is a very big number that we have estimated for this segment. Unless the residential real estate market improves in the next few quarters, I think this is going to be a segment which is kind of going to really blow out. Because out of this 2 lakh crore NBFCs, whichever are operating in this segment, many of them will have, some of them, not many of them, some of them will have even their solvency issues if residential real estate doesn't improve. So this is a segment really to closely watch for and see how this performs. Now that with pandemic, with moratorium, restructuring and all has happened, so again the stress has been kind of concealed. But once all these smoke screens go out, smoke screens of say the restructuring or smoke screen of moratorium, once these go out, the real stress will be visible. And unless in the residential real estate market improves, it's going to be a major issue for this segment. This is what I was talking about earlier, that NBFCs have raised confidence capital during the pandemic. I'm talking about the last bar, which is H1 FY21, about 19,000 crore, about close to 20,000 crore, which is almost 80% of the capital that they raised in the entire 20. So much of capital, large NBFCs and even mid-sized NBFCs have raised, which is really bringing that comfort to the sector and to those NBFCs as well. Again, that's about the performance that we have seen so far, but I would want to kind of spend the next few minutes before I wrap up the NBFCs talking about certain developments which has happened in the recent past. So because of the pandemic, I think the way in which business is getting done has really changed, particularly on the collection side. The collection side, I think what used to be, I mean, as I said, post demonetization, a lot of companies moved to uh, uh, disbursements entirely on non-cash mode, and collections were still happening on cash mode for many entities. But I think this pandemic has pushed them further in the digitization, and collections are happening through digital channels. That's a very critical development for the industry, which is actually will lead to better efficiencies. I will leave the rest of the thing for you to read, because I think in the interest of time, and also it is self-explanatory. These are the support mechanisms that government and RBI has given, which has really been very useful for particularly the mid and the small size NBFCs. Otherwise, we would have seen several defaults. Post the ILNFS, there have been several defaults, which actually blew away the confidence of the stakeholders in the segment. So we had ILNFS first, then we had Reliance, we had Altico, then we had DHFL. I don't know whether I've said everything. I think 4 or 5 large ones and the smaller ones defaulting. I think it kind of blew away the confidence of the stakeholders in the segment. During the pandemic, on the one hand, NBFCs were not, they had to give moratorium to their borrowers, so they were not getting collections. And on the other hand, they did not get the moratorium. Many of the NBFCs did not get the moratorium because RBI said no blanket moratorium for NBFCs. Banks can choose which NBFCs to get moratorium, to give moratorium or not. And therefore, many of them had to keep paying on their liabilities, repay their liabilities. And but for this scheme of 30,000 crore of NBFCs and 50,000 crore through NABARD, all these NBFCs would have been in real trouble. Forget about the growth. As I mentioned earlier, it's more about repaying their existing liabilities. And these schemes really help them to tide over the crisis of liquidity during the pandemic period. So, so what has pandemic taught them? I think very clearly, technology. Secondly, funding is a challenge. Funding, so the kind of confidence which even banks had prior to ILNFS, I don't think that's going to return sooner. It will take time. While you look at mutual, I mean, there are 3-4 major sources for lending for NBFCs. Of course, banks is the major source. About 40% of funding for NBFCs come from banks. About another 40% comes from mutual funds through bonds, investment in bonds and CPs, and the rest 10% comes from, say, deposits, foreign currency borrowings, and all that. 20% comes from other sources. So while banks continue to give this funding to NBFCs, mutual funds and insurance companies have really pulled back. If you look at the data of the mutual fund lending to NBFCs, that has come down significantly. Of course, CPs have more or less dried up, maybe except to the tune of 1% or 2% of the entire funding. So this funding challenge is going to continue. Banks will also not go overboard. They have kind of kept their exposure. Banks do not rock the boat, unlike mutual funds and insurance companies. Banks don't rock the boat. They continue to lend, of course, with adequate safeguards. But again, when growth comes back, I don't think banks will go overboard in lending, because we have seen Altico, we have seen DHFL under the defaults, apart from ILNFS. So banks will be cautious in lending to NBFCs. So I mean, why banks were so gung ho for the past 20 years? There was no default with any NBFC, and that's why banks were very comfortable lending to NBFCs. Most of the banks had breached the internal levels of industry exposure towards NBFCs. All those things have happened. All those things were there, and therefore they were gung ho in lending to NBFCs. But after the ILNFS and followed by a series of defaults, now banks are not actually very gung ho, but they don't rock the boat. They continue to lend in minimal amounts. But again, therefore, the lending challenge the funding challenge will continue, and co-lending is going to be a model. The co-lending model will kind of pick up gradually, not immediately. Will pick up where a part of the loan will sit. The NBFC will originate the loan. That is what they continue to do, but maybe 20% it will hold in its book. If I give a loan of say 2 crore, I will keep 20% in my book as an NBFC, 40 lakh. And the 1.6 crore will sit in the book of any bank or any larger NBFC. Typically, it will be a bank, and that's what is co-lending is all about. But NBFC will continue to originate and even service the loans. But this model, I think, which I'm seeing now, seeing traction, and will gradually pick up over a period of next 2-3 years. I'll not go into detail regarding the convergence of regulation. This slide is entirely about the proposed. This is the discussion paper brought out by the RBI for enhancing the regulation of NBFCs, because NBFCs, you have the largest NBFC, for example. I mean, forget about the likes of HDFC, which is 4.5 trillion, 5 trillion size and all that. But if you take the NBFC, say Bajaj Finance, which is about 1.4 trillion, and there are several NBFCs which are in the range of 80 lakh crore, 0.8 trillion to 1.2 trillion. So there was already a talk going on for past several years as to at what stage these NBFCs have to get converted into banks, because all these large ones pose a systemic risk. I mean, we know after the ILNF example, which is fresh in our memories, there is a huge systemic risk. If something goes wrong with these NBFCs, it is not just those NBFCs, but the entire financial system goes for a toss. And therefore, NBFCs are not as strictly regulated. It's a light touch regulation as compared to banks. And therefore, the idea of RBI in bringing out this discussion paper, and subsequently it will come out in the form of a regulation as well, is to kind of increase the regulation, particularly for those large NBFCs, and the largest ones the regulation will be more or less on par with that of the banks. So they have not talked about the very critical or very business friendly, or I would say the CRR and SLR aspect. That is not brought in the regulation, which is a comfort for the NBFCs. But tighter regulation is something which is on the cards for the large as well as the mid-sized NBFCs. But apart from that, what I hear from my circle of NBFCs whom I interact with is that the regulation has really become tighter. In regulations, I'm talking about not the regulations on paper, but the supervisory function which RBI conducts by visiting them, asking for data. All those things have become really tighter for bigger NBFCs. Just a minute. Again, there is a talk of a conversion into banks, and therefore I've just given the benefits and challenges of becoming a bank, which is not something new, which has been there for a long time. So that brings us to the end of the NBFC. I mean, if you have time, maybe another few minutes, I will take this credit ratings, or what we can do is to take questions on credit ratings, apart in addition to the NBFC. Are there any questions?
I think there is no question from the participants. We can. So I have one question. Whether I'm not sure whether to ask this. Can you express your view regarding on the privatization of banks, nationalized banks? Is it relevant to this topic?
Yeah, why not? So
Very relevant. It's a good question. Ramesh, you take it, then I will supplement it, and then we'll have Dinesh Kotecha's presentation.
yeah, sure.
It's a wonderful question.
So,
Please put your video on and identify yourself. That will be nice.
it's a very relevant question and very relevant in the current times. The efficacy of a public sector bank is definitely limited because of historical reasons, right? The government has to kind of keep pumping money for the growth of the public sector bank. There are very few public sector banks which are self-sufficient, probably State Bank of India or probably Bank of Baroda, very few who can sustain on their own. What I mean by sustain on their own is they can raise their own funds, capital funds which are required from the market based on their own strength of the balance sheet, their business profile. But there are other banks, loads of them, they have been now combined together and brought to 12. Therefore, the government has to support them. They will not have that wherewithal because of the lack of operating efficiency. And therefore, government cannot do it. So that is on the one, that is the first point. The government cannot continue to support these white elephants. Secondly, even if you look at from the economic perspective, are you making the right, are these banks actually adding value to the entire system? I'll give you an example. See, I've seen number of banks, smaller banks, bigger banks, while working with CRISIL. So typically what happens in these mid-sized banks is that if one bank sanctions a loan, say for a project, say if a project is 5,000, 6,000 crore or 10,000 crore, probably SBI or Bank of Baroda or SBI caps actually will do a assessment, and one or two banks, large ones, will sanction, and everyone will follow suit without actually understanding what the project is. I'm not exaggerating. See, SBI has sanctioned, Bank of Baroda has sanctioned. Probably they will sanction 5-10% of the loan. These guys will sanction 1 or 2% of the loan. Now, there were multiple problems. These guys did not have even their size did not have even the ability to sanction that 1 or 2%. 1 or 2% would work out 100-200 crores, which are big loans in their balance sheet, and therefore most of the banks are suffering. So they were not actually doing business, real banking business. So the value addition by these banks into the system were very poor. On the other hand, they were actually sucking out value. So my firm belief is that for efficient allocation of capital, efficient use of resources, right? I think privatization is one good way out. Of course, when you brought down the number of banks, that itself is kind of going to increase the efficiencies. But I think the ones which cannot be consolidated or merged, I think this is a very good way to take out. Of course, I completely take the point on personal front, industrial relations. I mean, you can't throw out an employee who has been all along been working in a public sector bank or make him work in a private sector setup. That's not going to work. So the employee aspect definitely needs to be taken care of. But I think that will be taken care of. I mean, government will have political implications, and I believe that there's going to be a shortage. Forget about the political implications. There's going to be a shortage of manpower in the public sector banks, which even Mr. Raghuram Rajan was highlighting 3-4 years back. So therefore, that problem can be better solved. And what's happening is something which is appreciable.
Oh. Can you hear me? Can I add something?
Yeah, please go ahead.
Oh, wonderful. It was a wonderful question. Can I know the name of the person?
Pradeep, sir. Myself, Pradeep, Deputy Kenyan. I have raised the question.
Wonderful. Pradeep, you have done a wonderful job. I will answer very, very clearly, and I believe in future we should have short questions and short answers. And one thing is, I'll just tell you why this presentation detail was selected. ILFS, whether ILFS, DHFL, Reliance Home Finance, lots of things. It has changed the image of the profession, right? Since the day, lots of directors resigned, lots of auditors were changed, lots of things have happened. Everybody is aware of that. That is why a detailed deep dive analysis was done. very, very clearly to get you a full understanding. Now we'll have short presentations, maybe 10 minutes. Dinesh, Kotecha will do, and Sandeep will do a short one. But this is a wonderful question. Look at Fortune 500 list. Have you seen Fortune 500? How many Indian banks are there? I've been interacting. In fact, I have a different answer than Mr. Ramesh. I've been interacting with Mr. Dinesh Kharara for SBI. I've been interacting with Mr. Chadda, the CEO of Bank of Baroda you mentioned, and I've been interacting with lots of chairmen of practically all the PSU banks. It is not about efficiency. Let me tell you, our PSU banks, many of them are very efficient. They can beat any private bank in terms of any parameter, whether in terms of asset quality, whether in terms of ROI, whether in terms of NIMs. They can do it if given a free hand professional management. And SBI is among the best managed banks. It has been acknowledged globally. And about BOB, it is not just about BOB. There has been a spate of mergers. In fact, in my keynote address, I had written down of M&A. Each of you can contribute to M&A very, very big way. So efficiency, point is how many banks are there in Fortune 500? There is a clear, how many Chinese banks are there? How many US banks are there? How many Europe banks are there? How many Japan? For India growth story, we had to have maximum number of banks in the Fortune 500 from India. There is no alternative. Very, very clearly maximum. How many out of 500? How many banks are there? In top global banks of top 25, we have one participant here who is working at a very high level with a top 25 global bank, right? He is there with us. And that has to be done. And for that, we need consolidation, whether it is PSU owned, let the government own or Indian people own 100%. Efficiency is there. But we need maximum share in top 100 banks and top 10 banks, and 50% should be Indian banks in growth of in ahead of time. Efficiency will come if it is market driven and opportunity is there. Sandeep, have I answered your question well? If not, please challenge me.
It means, sir, we have to say that in 1969 the government of India was wrong.
No, right? No, it was not wrong. Pradeep, let me be very clear.
What Ramesh is talking is that
there were compulsions, there were political compulsions. Even today,
there was no political compulsion. It has been proved also. After 1969, there was a huge growth in the banking industry, and because of the economy what we adopted, sir, we cannot compare ourselves with the US or so Europe, which is a completely developed economy. So diversification of the fund was necessary, sir. And that was the government wanted to achieve in 1969 when they have nationalized the 14 banks first initially.
Can I come in here? I'm Sandeep here. I can actually. I'm a panelist. I'm going to talk later. But can I actually intervene?
One second. Sandeep, can you just wait? Pradeep, you have raised points of nationalization in 1961, 69. I wonder how many members.
Dave sir have raised, our other speakers here, Rashmikant Dave sir, senior member, have raised that point.
Yeah, I wonder how many members were born at 69. There were compulsions at point of time. There are compulsions as of this point of time. But we have to be very clear what needs to be done. And also, if divestment is there, the process of divestment, the transparency of divestment is very important. Whether they are given to one or two industrial houses, or you as a retail investor, as a professional investor, you get the opportunity to bid. Whether employees get opportunity to bid, right? In the US, you have got leverage buyouts. There are buyouts by employees. There are buyouts by management. Whether that can be done, that is the thought process which needs to be done. Well, why not employees or the bank take over? They get opportunity, right?
How many banks in the US are nationalized?
Sorry?
In the banking industry of the US, how many nationalized banks we do have? Almost 90% banks are the private banks over there since the many years rather.
Well,
how can we compare US economy with the Indian economy?
I'm very glad this discussion is happening. In 2008, everybody knew there was a backdoor nationalization. Who picked up stakes in the city banks and all that? It happened because of stimulus at that point of time. And same thing has happened this time now. Everybody knows how Warren Buffett, through his firm Berkshire Hathaway, acquired big stakes at throwaway value. I'm glad your point has been raised, and the thought process is there. It's not a point of what was right. We don't know. What is happening today, we don't know. We can only contribute the process is transparent, whether you get opportunity to bid and whether Pradeep gets opportunity to participate in the India growth story and creates wealth for himself, his family, his clients and stakeholders. Am I right?
Okay, fine. Same answer will get what Ramesh has given few minutes back about the demonetization. It was a failure, and we will see after 1 year that this is privatization step.
I have no comments on political views on making judgments of the past, which I am not myself aware of.
Sorry, sir, we can't keep it away, ourselves. What is we are talking about, is the economy of the country. And banking is the artery for the economy of any country, sir.
In fact, I would be glad to have Dinesh Kotecha's presentation, a short one, and Sandeep's presentation, then a continuous interactive session on all the issues.
Sorry, Manoj, can I just intervene, because this is a question which I attended a conference. I'll tell you. I attended a conference.
And your presentation.
I'm sorry.
The presentation, and let's interact on all issues, so every participant gets opportunity to interact.
Sure.
10 minutes Dinesh Kotecha can do, and of course everybody can come in interactive session.
Thank you, sir. Now I request Vikas Nikum sir to formally introduce Dinesh Kotecha sir. Vikas sir, please provide the introduction. Sir, you're not audible, Vikas sir.
Yeah, am I audible now?
Yeah, now you're audible, sir.
Okay. This gives me a great pleasure in introducing our very own faculty from our own region, CA Dinesh Kotecha sir. His principle is that have been living life on the fair principle of not to exploit or not to get exploited. And he firmly believes that natural things and simple things are always beautiful and should be appreciated. Mr. Dinesh Kotecha sir is the founder convener of our Vasai Virar CA study circle of WRCA, and he has delivered various lectures on equity and stocks at various forums of different study circles, which at Vasai, Bhayandar, Aurangabad, and other Rotary meetings and land clubs. CA Dinesh Kotecha sir is FCA since 1993 with a high interest and dedication in equity research, along with main focus in professional practice towards corporate consultancy to SMEs. He has rendered services as independent director in the BSE listed company from Belagavi from the year 2007 to 2011. Presently, he is also an independent director in a BSE listed company from the year March 2020. CA Dinesh Kotecha sir is born, brought up, and his education is completed in Vasai, graduated from the Dhanukar College of Commerce, Vivekananda, and he has completed his apprenticeship training from PGO Company Chartered Accountants of belonging to the Mumbai area. His other interest is that he is interested in more listening to soft music, reading biographies of self-made successful people, and very interesting fact is that he is very writing thoughts on life in general and investments in particular. We are very hopeful that his writings will be published in the next year. So, kindly address the session. We welcome you all.
Can I just speak for 30 seconds, Dinesh?
Yeah.
Dinesh, hello.
Yeah.
Dinesh, while you put your PPT on, now it is about 6 o'clock. I would suggest about Dinesh has got 8 slides, 10 to 12 minutes by Dinesh. That will be 6:10 to 6:15. And Sandeep has got about maybe 20 minutes. And then 6:35, as the conveners requested, 6:35 we have a 25-minute interactive session which has already started. And we have so many people, we'll have short, crisp questions and short, crisp answers, so that the maximum number of participants people participate. And in case you want to extend the session, all the team panelists will be available to answer questions by everybody. Just keep the questions short and answers very short, and let's have about, let's keep the time discipline, so we have the maximum benefit to all the stakeholders. Dinesh.
Yeah. Good evening to all of you. Since this is my home ground, first of all, sorry. Am I audible?
Yes, sir, you're
Very
audible.
Yes,
Yeah,
yes,
very
Yeah.
good.
yes.
Yeah. Uh, Yesterday we had an election of the CA, Vasai Virar CA CPE study circle, and very thankful that the outgoing chartered the conveners Hiren Pandya, Kunal Modi, and Pradeep Jaiswal has organized this webinar today. Welcome the new conveners also. My presentation goes to the case study of Reliance Industries Limited. Now, this Reliance Industries Limited. Give me 1 second. Yeah, this is my disclaimer. Coming to the first slide itself, Reliance Industries Limited is a. Arre? Huh.
Hello. Uh, I think there's a network issue from Dinesh sir end.
I think we wait for 5 minutes for
Yes, sir.
the
We'll wait.
skip.
Or can Sandeep start? Depends on the what the conveners decide. Sandeep can start his presentation. Are you ready, Sandeep? Sandeep, are you
Sandeep, sir,
ready?
you're not.
Yes, I am ready. I'll
Maybe
just
with the
have
permission
to.
of the conveners, I think we can use that, save that time. If the depends on the permission of the convener.
So we'll wait for 2 minutes because he was ready with his. Wait for 2 minutes. We should. Convener sir is contacting to him, I think.
We have enough content for a full day digital capital market summit. In fact, while he says I'll share my experience, we had the annual capital market summit at ICAI Towers, and it happened on 8th floor. It got packed, and right from 9 o'clock it went on till 8 o'clock. And at 5 o'clock we asked anybody wants to leave. CPE slip was given at 5 onwards. Only 2 people left, and they apologized. The meeting went on till 8 o'clock. There were co-panelists with me, some CEOs. I had given a keynote address in the morning, and co-panelists were CEOs of some of the top mutual funds and AMCs and corporates. And it went on till 8 o'clock. Very clearly, even then people were not willing to go. And we know what happened in CP programs by organizing units after they give the slip. Physical annual capital market summit in ICAI Towers a few years ago. In fact, people were asking for seats, registrations were closed. I'll sit in the third row or the second row, and they wanted to participate and hear the discussions, panel discussions and the keynote address, and how everybody gets engaged. In fact, we have moved forward. There is more advantages, more learnings, and each of you is getting a benefit of that. Digital is in fact far better. In fact, because of the Dinesh network issue, I got opportunity. This is a type of kind of a platform. The current conveners and Dinesh mentioned about the current future conveners. I think what is the applicable date, whether from today or 1st April. So they are getting the benefit of this digital.
1st April. 1st April.
Okay.
In fact,
Okay.
today we have handover also after the program.
Or today it is joint, is it?
Yeah, in today's program we are going to hand over.
Yes.
Okay, it's good. I think you are inspiring them by setting highest benchmarks.
Yeah, yes. I think,
Yes,
sir,
sir.
we are unable to contact Dinesh, sir. So we'll start with the Sandeep sir session.
I know I would have saved your 10 minutes, but
Yeah,
anyway, I shared that experience.
Okay,
I should have listened to you
can I go
actually.
ahead?
Sir,
You,
wait. Sir, I
I'm
request
just,
Vikas sir to first introduce Sandeep sir. Sandeep Bhat sir.
Okay.
Yeah, in the meantime, I'll
Yeah.
share my screen.
Yeah, sir.
Yeah.
Sandeep sir. Vikas sir, please proceed with the introduction.
Yeah. Uh, Let me introduce Mr. CA Sandeep Bhat. CA Sandeep Bhat is a chartered accountant as well as a CPA from Australia. He has over 35 years of post-qualification experience in accounting, financial control, tax management, and operational risk control, legal, compliance, and optimization of IT and administrative resources, of which 30 years have been in the financial services industry with firms like Aditya Birla Private Equity, UBS, CLCA, and ABN AMRO Equities. CA Sandeep's career highlights include setting up the Aditya Birla Private Equity Fund, membership of the Central Committee of UBS Zurich, involved in conceptualizing, planning, and setting up of its offshore center in Hyderabad with 3,000 capacity. He was also a key member of the team formulating plans and devising systems for UBS to set up their bank branch in India. Earlier, CA Sandeep Bhat set up FII broking and investment banking division of ABM AMRO Equities in India and the investment banking division for UBS in India. In all his roles, CA Sandeep developed the management and operational risk control systems, monitored the compliance, and was instrumental in optimizing the IT and administrative resources through process automation, in addition to his primary role in financial sector and accounting. So, we warmly welcome you, Sandeep sir. Please share your ideas on our digital capital market summit. Thank you.
Thank you, Vikas sir.
Yeah,
Thank
thanks a
you,
lot.
Vikas sir, for
And
the wonderful introduction. And now I request sir to start with the session. Yeah.
yeah, thanks a lot to the conveners. In fact, thanks because for the the kind words about me. What I intend doing is actually since the experience has been quite a bit, I would talk more on the experience, and I would urge all the participants actually to the question which comes up every now and then: do students have the practical knowledge of studying, whether it is in school, whether it is in your CA curriculum? That is the most important. And from my point of view, I think I urge each and every participant to be, you have to have a think tank participation where you ask questions if you are not aware of, and you interact with those who have the knowledge. I am still learning, and that's what I would say. To come to the think tank VivekPatra, which we call, and thanks Manoj for introducing this concept. It's a concept where we want to actually dwell on the subject of truthfulness. Let me go back a number of years back. People used to ask me, why don't you go abroad? You've now become a chartered accountant. There are many things which and opportunities which are there abroad. And I said, no, I'll stay in India. I want India to grow, and that's the India growth story. Now the point is why um, I remained here to see, and I knew very well that the foreigners will come here ultimately and set up shop here, and that's how all these uh, ABN Amros of the world, ABN was there. All the UBSs and all the other FIIs started coming to India. Now the point here which I want to make is, I stuck here to India. I wanted India to grow. India did not grow. Why? And the more important reason, and you will get this from every nook and corner of the world: transparency and governance practices are the most relevant in today's environment. And if you don't have transparency and truthfulness, it's a shocker. and any company which wants to get listed is doomed if these two things are not prevalent in their system or their culture. Now, to go ahead, actually, let me go very fast because I don't think I have time enough to really go through the entire presentation. The first thing which I am going to rush through is governance, regulations, and the best practice of how to actually be in touch with the regulations.
I would request, thanks Sandeep, the way you introduced the concept of the VivekPatra. Vivek in Sanskrit, is discrimination between right or wrong and knowledge and wisdom. I would in fact request, while this slide is on, if the organizer can request every participant to put a video on, it would be a very good incentive for the organizers. Even for a few minutes, put the videos on everybody. That will be really nice. So one can relate and have them on the screen together. If it is possible, I believe that should be encouraged.
Yes, sir. Yes, sir.
It's a digital capital
Yes, sir.
market. Everybody, past conveners, present conveners, coordinators, participants, everybody. In fact, we want 52 financial wizards to emerge among the participants, and each of the 52 convince 1,000 other people to become wizards and contribute to the VivekPatra.
Absolutely, and that's what we want. Contributions from each one of you. The subject might be, you might be an expert on that, you might not be an expert on that, but I think the ultimate task and the ultimate focus should be how will you grow and acquire that practical knowledge. And I'm talking of the younger generation, and that is the focus of my discussion here. Can I go forward?
I become young also when I listened to the deputy convener about that 1969. All videos, if it can be on, it will be nice.
Yeah. So let me go on. And,
the process has started. Everybody will become an expert, I assure you.
Thank you. Thank you. There might be some forward-looking statements which are made by me in my presentation, and this is a complete disclaimer to the effect that each one of you will, from your point of view, study the RHP, study the topic in detail. You have to have an access to your investment advisor. Only then take the decision. So if I'm saying something, please don't go on my decision or my whatever I'm talking about, but please go through it again and take your own decisions. I'll rush through this because I think what I'm focusing here is there are regulations which are very, very important from the point of view of the financial sector. And the most important thing which is there is the regulation from the aspect where SEBI comes into the picture, and a list of all the what I've done is listed out all the circulars and points which SEBI has come out with in the month of March. And if you actually, I think this will be shared with each of the participants, and I don't mind, this being shared. The whole thing is you can actually go onto that link and go to the circulars, read through it carefully, and see what it is. This is to actually gain knowledge on what is happening in the stock exchange or in what is happening in the regulators' minds. So, for example, a review of the delivery defaults norms with respect to commodity trading. If you remember, there was a big scam in terms of the commodity trading platform. Now, this got transferred to SEBI. SEBI is now trying to make regulations in terms of the commodity exchanges, or they are the regulators for the commodity exchange and they want to do it. And this is how it is transpiring. And if somebody is trading on the commodity exchanges, this will be relevant for them. So the other circulars, in fact, are clarification on valuation of bonds or guidelines for BCP and DR for market infrastructure. And this is very relevant where Manoj, in fact, said NSE was, shut down for 4 hours, the NSE, whereas the BSE was on, and you could not pass on any trade if you had a position on the NSE. So the regulator is actually conscious of the fact and now coming out with detailed views and directions on what the exchanges need to do. So there are, like that, there are several others which you can actually go and check it out. There's one circular on mutual funds. There are guidelines on votes cast by mutual funds. And here, this is an important circular where the mutual funds have been asked to actually go and vote for any resolution mandatorily for any resolution concerning governance or any other practices. So you need to see the mindset of the regulator. We actually want governance to be the most important factor going ahead. Then you have the code of conduct and institutional mechanism. So all in all, what I'm trying to say is we are heading towards what we wanted, or rather I wanted 30 years back. After SEBI, it's the super regulator, which is the Ministry of Corporate Affairs. There is a website there, which is www.mca.gov.in. So all the circulars or directions or notifications for the Ministry of Corporate Affairs are listed out there. And the latest one, in fact, amendment notification to Schedule 5 of the Companies Act 2013 is also there, which relates to the remuneration to directors. So other than the executive directors, you have it is called the other directors remuneration also needs to be limited, is what SEBI is saying. So again, it's a point on governance. Then comes the regulator, which is the RBI, which, from the point of view, Ramesh, in fact, had, a lovely presentation on NBFCs. RBI governs NBFCs, banks, and now, in addition to that, they are now going to regulate even the cooperative sector as well. So we are heading in relation to regulations from all aspects. Even here, you can go and check out the first one, for example. How do you actually amalgamate urban cooperative banks? There's a detailed guideline on how to do it. And so people possibly might want to, whoever has a mandate, for example, can go and have a look at that. You have the insurance regulator, where insurance companies need to have policies in place on an electronic platform also. For example, since the problems of COVID arose, the regulator, which is IRDA, has allowed the policies to be issued on an electronic basis. And this direction has been extended to the 30th of September 2021. So you don't be surprised to get policies by way of an email or electronically. So we are heading again to a digital world. So from that aspect, digital governance, regulations, and help to the people generally. This is a broad point on, in terms of where are we on the insurance sector. If you see right in the middle, crop insurance, which is the insurance which has grown the most? Crop insurance has grown 102.66. And look at it this way, the government on the one side, and this is a topic which I want to take and I wanted to discuss. on the one side, the government is actually taking up the position of amalgamating banks, and there was a question to that effect. On the other, if you have the other outlook, there is what is called impact investing. You have the MFIs, you have the NBFCs, and others. So and the accounts which have the millions and millions of accounts which have been opened in terms of passing on subsidies. There are two aspects to it. If in 1969 that step had been taken when banks were actually nationalized, if, for example, the Jandan accounts had been opened, it would have made a different scenario. But better late than never. It has been done now. The corruption in terms of subsidies would have reduced to a great extent if it had been done earlier. To come to what it is now, you have the subsidies which are going through directly to the person's accounts. MFIs and others are giving loans on a priority sector lending basis to women and others. So don't look at it from one perspective that there are banks which are being amalgamated. It is not so. And I was to talk about this because I was in a conference. I was sitting with the managements of SBI and the other PSU banks, and the topic was, and this was conducted by Symbiosis Institute, the topic was why should we not amalgamate public sector banks? Now, to compete with the foreign institutions, the foreign banks have come here. We need to be competing with them. So which is the bank which can compete with them? And like Manoj said, SBI is one. Now we need to have other banks to compete with them. And Indian money, the Indian financial system is scarce for money. We are dying for money, which has to come from abroad. And if it has to come from abroad, it means the foreign banks have to bring in money here. And if they bring in money here, will the Indian banks survive as with being a small entity? I don't think so. And that's one of the reasons why you need regulations on or steps to actually amalgamate banks and see to it that there are proper incentives for priority sector lending. So both the foreign banks as well as the private sector banks and the amalgamated banks, as they would be called, need or will be pressurized to give priority sector lending. This is my short answer to that question which was raised earlier. In terms of crop insurance, the government is also actually focusing on this, and the government is very clear, on this aspect as well. And that's one of the reasons why you're seeing the crop insurance which has gone up. Then, of course, this is bread and butter for us actually in terms of taxation, or I should now say it was bread and butter earlier with the faceless assessment schemes. It might no longer be, but then people will come to you definitely for filing of income tax returns, and then you won't have the time, or rather the SSCs won't have the time to actually look at assessment on the basis of the digital aspects. So you will need chartered accountants to actually help the SSCs for getting the assessments done. For all you know, the finance bill for 2021 has already been passed a couple of days back. So now the budget is in fact law. Then you have what is the IBC in terms of insolvency cases. That is helping the public sector banks as well. What really happened earlier and what is happening now, again, It's
Sir, I have
cleaning
one
up
question
of
on in
the.
IBC. Can I ask
I'm
one
sorry.
question, sir? Sir, I have one question on
Yeah.
IBC. Sir, in IBC, whatever the resolutions are coming, the bankers are taking very big haircut. So, miss, I think bankers are at the loss taking such a big haircut. So, what is the purpose? And the corporates are getting benefit of not paying that percentage of amount. So, is it
Uh,
beneficial?
what would happen? I would rather put that question back to you. What would happen if this, you know, IBC resolution is not done at all? We have been mounting bad debts and NPAs for all these years. If the resolution doesn't happen at all, this will keep on mounting. And this is one more advice which I wanted actually to give to the younger lot. And I've been taught in these MNC organizations not to keep, and I will repeat this again, not to keep any problematic cases or issues under the carpet, which means if there are problems, please, put it up to your management so that there is a resolution to that problem. And this is what this government is doing. Mind you, there might be a haircut. There, I for one know that possibly the entire amount of interest is being waived. On top of that, there might be a 20% haircut on the principal amount which was outstanding. That
Can I add
that
something?
might
Can
be
I add
possible.
to that? Can I add to it?
Yeah,
On
please.
Acha, can I know your the question was very good. Can I know your name, please? Hello. Can we have your video on your name, please?
Sir, I have raised the question, Pradeep, Deputy Canon Pradeep Kumar.
Oh, wonderful. Are you are raising wonderful questions here. I think you are going to be inspiration for millions. Now, IBC, I'll tell you, I have connected with IBC people today, including the people who have been involved in drafting the IBC code and on IBBI also. It's a very valid question. The point is there is no good price discovery of assets. If the assets are being acquired by the bidders at throwaway prices, definitely the haircut would be higher. I had a personal long discussion with the MD of Tata Steel, Mr. Narendra. Narendra, he is also now involved in CII, heading the CII maybe next year. This year, Uday Kotak is in charge. I had almost a 45-minute discussion with him on acquisition of Bhushan Steel. Everybody knows Tata Steel acquired Bhushan Steel, right? And which was supposed to be a forensic and fraud case. It is reported in the papers. I also had an extensive discussion with the CFO of Tata Steel, Mr. Kaushik Chatterjee, on those issues extensively. And that was a case, in fact, even operational creditors who are short-changed in many other IBC cases, even operational creditors got 5%. And good amount, a good amount over 100 crores was given to operational creditors. So price discovery is important, and the transparency in bidding process is important. And sometimes there is a rush. And who are the bidders? There has been backdoor bidders. Sometimes they say that ARCs or foreign investors in collusion with ARCs are acquiring assets at throwaway prices. And there is no transparency, ownership of those structures. And some people say promoters can't buy because of certain section introduced, that bad, ugly. This is again the good, bad, and ugly. If they can't do it, they are buying through special purpose vehicles, and they are doing that, and they are able to get away because of we are a democratic setup, and there are rules and guidelines and bureaucracy involved, and transparency is improving, and so hopefully it will improve, and hopefully what you answered, price discoveries improve if the bidding process improves and more people participate. Same thing was related to your PSU banks, how people bid for it and become owners. Same thing here, how people participate and acquire. And if you get to know what about the DHFL bidding, right? Who acquired? Somebody, one industrial group was acquired. The Piramal said, we will go to court, and we want to bid. And then otherwise, the other group would have got all the assets at throwaway price. And the bidders today, there is more transparency. I don't know about transparency. In fact, I don't think there is transparency fully. And there is greater value offered. So if there is a more transparent process, there'll be much more assets, the value in HFL, and not only the bankers, even the shareholders can good value if there is proper price discovery. And today,
Absolutely.
what about bankers? Even the shareholders are being short-changed.
Absolutely.
And we can discuss a 10 and 20 other IBC cases with you if you have a session on IBC separately.
Yeah, I'll just add one more point to what Mr. Sandeep and Mr. Alimchandani had said. See, I think when you look at the recovery rates, it was sub 10% under the earlier regime, whether it's a debt recovery tribunal or under even that time SURFACE, whatever, it was under 10%. Now, if you look at the recovery in the past few years after IBS implementation, it has gone up to 45%. I mean, the number may be little misleading because recovery has come in some large cases, but certainly the percentage of recovery has been far better than in earlier cases. So definitely, in addition to what Mr. Alimchandani said, that they used to circumvent the system, game the system. All those things are not possible now. People have lost their companies, right? Promoters, rogue promoters have lost their companies. So both in terms of recovery as well in terms of cleansing the system, I think this is a very good piece of regulation.
I'll just add to one of this, with an example. Since I've been in the private equity field, and I know of a power company which manufactured equipment for the power sector, that went bankrupt. None of the capacities were online. It went completely dead. Now they're coming and actually trying to work out a solution where it is being taken over by a company which will, take over, but that lost asset which is there, which was idle, will come up again as manufacturing. You look at the aspect of the GDP growth, which would not have arisen in case there were idle assets. So that is one more, you look at it from the positive side and don't look at it from the negative side. There are negatives. Transparency is a factor, but we will have to look at it like Ramesh also has said. The amounts which are there have gone up substantially. The recoveries have gone up substantially.
Can I add something to answer Pradeep's question? Can I add something with your permission?
Yeah, please.
See, I'll tell you the way this program is going on today. It is excellent. It was our aspiration. I wonder how many slides are there, but what slides have been discussed is fine. I wanted 3 more slides among that 50 participants I see now. Earlier there were some 57 or 56, whatever. I wanted 3 slides, and I'll be very, very happy if there are 3 slides. On one slide you add on privatization of banks, and one more slide you add on IPC talking about the haircuts, and also in the last page there is an acknowledgement pledge, right? A big thank you to add Pradeep's name in that, and add at least 2 other names. You can work jointly with any other 50 people, anybody. Some people have good writing skills, some people have good speaking skills, and some people have got good research skills. So everybody, right? Sandeep, am I right? On the last page, you add their names who can do research and who can even help you do that. But they should understand and be a part of ThinkTank VivekPatra. Add 2 or 3 slides and circulate to all. If you do that, I feel the whole objective of the digital capital market will be fully achieved. And I'm just waiting for Dinesh Kotecha's experience on what he has done for 10 minutes. He has got 8 slides. Anything else? We can do a session on IBC. A team can do. I may or may not be there. We can do a session on privatization of banks, right? We can do on SEBI regulations. We can do on research. We can do on 20 different sectors. Whichever topic you want, we can address it. And with you as participants and with you as contributing to wisdom and knowledge the truthful way. Be truthful. We want you to drive the session
Dinesh,
actually.
taking over?
Is Dinesh Kotecha there? Because you had said 25 minutes for interactive, and of course Pradeep has spent a good amount, 15 minutes already. What is the Dinesh Kotecha's status?
Yes, I'm there. I'm there.
Can you get him? I believe he has joined again.
Yeah, so Dinesh sir is back.
We can come back to these slides later. Let's hear him out. His experience story is very vital.
Can you hear my voice?
Okay, sure.
Everybody,
Even
Yes,
without
sir,
a people,
you're audible.
experience
You're
story
audible.
for 10 minutes is very vital.
Yes, yes.
am I audible, sir? Am I audible?
Yes, sir. Yes, sir, you're audible.
And something about Dinesh, his slides are already, one of his already there and one of the slides on looking at AGMs, right? Sandeep? Understanding AGM,
Sorry.
annual report.
Yeah, sorry. First of all, there was an interruption from my side. There was a connectivity problem for which this is delayed. Now my slides are appearing. I'm sharing my slides now for a minute. Just for a
Wonderful,
minute.
wonderful. It is already there in VivekPatra also understanding annual reports and AGMs, right?
Yeah. Yeah.